Good morning, everybody. Good afternoon to my friends across the pond. I hope everybody's doing great. Happy Friday. I've got a big agenda for you guys. For those of you who don't know who I am, my name is Mark Sebastian. I am the founder and CEO here at Option Pit. We started this firm back in 2010. That's right. It was just our 15th anniversary. Think about that, guys. This company is about the same age as my kid. He was 3 months old when I started it. Much to my wife's chagrin, might I add. But I am very happy to be here. We are going to dive into a lot of different things. I'm going to talk to you about the market as a whole, what I'm seeing and why. And then I want to talk about the one ticker. And you're saying, Mark, what is the one ticker? The one ticker changes a lot. But that one ticker is typically the one ticker that is telling us everything that's going to happen with the market that day. And I'm going to kind of tell you how I come to those conclusions and figure out what's what. Then we're going to talk quadruple witching, triple witching, which is this morning. Now, if you're wondering why things are funky and moving around a lot, I'm going to explain quadruple witching and what it means and why it's so important. Then we're going to talk about two big events that are coming up, and then what those mean for the VIX and options. I'm going to talk about what I believe is a potential great special situation forming. And Andrew's then going to hop on and he's going to dig into some long-term trading ideas using option fingerprints. So we've got a full agenda for you guys. We got plenty to cover, and I'm excited to be here with you. All right, so let's dig in. So, AI has been at the centerpiece of everything we've been talking about now for about 6 months. So I thought for fun, I would take my agenda and put into AI and see how good of a presentation can Gemini create. So here we go. If we want to share my screen, Mark, put your cereal bowl away and stuff. So, as you can see, this was their first AI generated slide, and it's our Friday deep dive. And I'm going to tell you again what you need to know. Quadruple witching, we're going to talk about that one ticker, and so on. So, all right, finding the one ticker. All right, volume and liquidity. We're analyzing market news and sentiment and tracking institutional trading activity. This is nothing. That is not really what we're doing, but that one ticker. All right. So at any given time, there is one asset class that is driving the market. Sometimes that can be tech. It can be banking. It can be treasuries. It can be gold. It can be Bitcoin. Right now, it is oil. Now, how do I know it is oil? Because I can literally track the S&P versus oil and see how when oil sells off, it starts rallies. And when oil starts to rally, like it did at 8:30, that's a sign that markets are going to top and roll over. So you look, we got a nice little rally in oil from 72.75, this is WTI, up to about 73.5, and S&P futures dropped 20 points. So right now, if you want to know where the market is going, you need to be looking at energy. It was bonds were such a leadership group and it caused such problems. But right now, it is all oil. You can use USO. You know, it's gone from down to back to up. Markets don't like that. So how do you determine what is that driver? How do you determine what is that driver? Well, it's not an exact science. But here's what I can tell you is that we look at it, you know, it's important when you go on something like, I don't know, CNBC.com. They literally tell you what are the major asset classes up top. You can see oil moving around, Brent down big, but WTI not as much. So they kind of tell you all the different asset classes that, you know, traders look at. Now, there are other ones that are out there, but, you know, you have this listing of names that generally are the leadership group. And of course, they give you stocks first, which are the least important out of all of these groups. You know, the energy market's way bigger, the bond market way bigger, maybe not gold. But so you've got that. All right. And so then what I'm doing is when we have an event and the world is moving around, I'm looking for changes in volatility. So I'm going to pull up a chart of the SPX here. All right. And I'm paying attention to the red line. Now, what I would point is out of this Iran-Israel conflict, we did see an increase in volatility, but nothing crazy, nothing like we saw back in April. Bonds, kind of a similar story. Little uptick in vol, not a lot of movement, just kind of hanging out. Now we have gold. Similar story, right? A little uptick in volatility, but nothing crazy. And we're back down. Now, look at energy. I would say energy had a much bigger move than it's had over the... I would say energy's had a much bigger move than any of the other ones by far. And so what you can do is literally set up these volatility indexes, and they'll kind of tell you what's happening. So what are the major volatility indexes that you want to pay attention to? All right. GVZ. And write this down, guys. GVZ is the gold VIX. Not telling us a lot right now. All right. And then there's obviously the VIX. Right. There's actually a VIX on TLT. VXTLT. It's not doing much. And then there's the gold VIX, which tells you the story. And So having the different volatility ETFs up can give you a lot of insight. And so we can clearly see, using volatility, that the one ticker we need to be on top of, the one ticker that matters to us, it's oil. Yeah, MOVE is the other bond ETF you could look, bond index you could look up. But the problem is that's not going to show up everywhere. You almost have to Google it, and it only updates once a day, unfortunately. So it's not the best, but I can tell you bond vol is way off. All right, so the trade that we want and we need to be paying attention to is oil. And you will notice that when oil goes up, markets drop. And when oil drops, markets go up. At least till we get back to a normal level. Do I pay attention to skew indexes? Yes, I do, but I don't think they're good kind of market leadership indexes. They can give you information, but not the kind of information we need. The information I want to know is what's going to drive the market every day. Right now, it is oil. And there you have it. That is how you find that one ticker using the volatility ETFs. So write that down: GVZ, VIX, VXTLT, and OVX. There are other volatility ETFs, volatility indexes out there, but one of those four is usually going to drive the market. So, is there a Bitcoin vol index? There is. What is that? Bitvol? Yeah, I mean, I can get it off of there is, and VIX actually does track crypto pretty well. When I'm looking at crypto, I'm pulling up something else. All right, now let's dig into quadruple witching. All right, sometimes called triple witching. You can use them interchangeably. All right, triple witching happens 4 times a year. It happens in March, June, September, and December. It marks the expiration of key derivatives, index options like SPX, futures and futures options like S&P 500 futures, and equity options like SPY and EM and Apple, all at the same time. Typically, it does bring about an increase in volatility, and you have traders adjusting positions in and out. So you'll see it's weird they had the day off before expiration. It is absolutely weird that we had that off the day before expiration. So that is what it is. So talking about that, SPX June options, the ones that say AM, all expired this morning. Now you have the June afternoon options as well. These don't do as much volume as the June regular. AM is the regular settle, by the way. But they are extremely important. And there's a lot of volume there still. So S&P futures, gone. All right. The June future, expired. Looks like it settled 609 and a quarter. But that is no longer trading. It is gone. Now the future is June or September, excuse me. And then you have options on like SPY expiring this morning as well. And so that is what we're looking at there. Those expire today. Now, how much is expiring? And this is the biggest expiration ever. All right. It is $6.5 trillion in notional value that is expiring today. All right. A bunch of it, the S&P 500, the S&P futures, S&P futures options expired this morning. The rest, SPY, EM, SPX PM options, those expire this afternoon. But this is just incredible amount of money that is going the way of the dodo. Traders have already basically made adjustments, or they're making additional adjustments right now. And you can generally expect some additional volatility for the days ahead and immediately after expiration. And so an interesting thing to look at is, okay, we expired. Where were kind of the major spots of open interest where there might have been some, where some air pockets may be developed? Traders owned a lot of upside. And on the downside, there's a lot expiring, but most of it is kind of hedged off. So what looks like is kind of coming off the books today is a lot of upside speculation. So market makers don't have a lot of upside exposure right now relative to what they had yesterday on a major rip. And that is going to be your key here. is what kind of exposure are market makers left with? Because when that exposure disappears, what does that do? It creates air pockets. And so we've got kind of an air pocket up if we get some resolution in the next day or two for the market. Joby asks, don't most traders manage their positions ahead of triple witching to avoid any issues? Yes, they do. But, when I am, that doesn't mean air pockets aren't created, because a lot of this upside stuff didn't have a lot of value, but it was part of the market maker's inventory. So all those coming off the book clean up the market maker's inventory. They no longer have any short upside exposure or long upside exposure, depending. And now the market is free to move. All right. Are the market makers buying and selling based on that? Why aren't positions immediately replaced? So, why would I replace being short the 6250 calls or the 6500 calls? It's just about how order flow happens and how trades come in. So market makers are building inventory throughout the month as markets move around, both short and long. When that inventory comes off the books, then, like I said, that creates pockets of air where market makers don't have exposure anymore. And so if we get a move, we can really get a move. All right. And as I'm talking, we have rolled over. No here. So quadruple witching, it's important. You've got to pay attention to it, and you've got to stay on top of it. All right. So now, post expiration, again, we have those air pockets. We need to access new dynamics, get ready for the JP Morgan roll and the 4th of July. All right. And traders are focusing on new trades. And typically, you get this little pump in implied volatility, and then it comes in. So I want to talk about this JP Morgan roll and how important it is. All right. This is a singular trade that is done for size. It's done by JP Morgan, and it's done to hedge their book. And this one is a unique one. They're actually costing their clients money by good amount. So what JP Morgan does is buy a put spread, and they sell a call to pay for the put spread. It is a collar strategy. I don't believe it's well managed because they fail to monetize. And frankly, they tend to roll at the worst moments. So let's take a look at what they did last quarter. This will take a second. I mean, just this, so you guys can see how active this thing is. It is crazy. I want to show you this trade. So we're still in the opening minute. There we go, 9:35. We're finally there. Things will slow down here in a second. I mean, it is just awesome how much activity they do. I don't know if I'm going to go through all day to find this trade. I'll just tell you what they did. All right. So JP Morgan does this quarterly. So it's going to be June. So they sold the 5905 call 40,000 some odd times. 44,000 times. All right. So they sold 44,000 of these 5905 calls. They're currently $80 in the money. And then to hedge the downside, they bought the 5310 put and they sold the 4850 put. So you're saying, Mark, why would they do that? It's in the money. Well, look where they were when they were doing this trade. Right here. We were trading 5611. Now, here's what's frustrating, right? The S&P dropped to 4840. So their hedge worked. But guess what? They didn't monetize it at all. So on the lows, and this is why that strategy isn't good, on the lows, they did nothing. Yeah. So let me show you what the position looks like as a whole for those of you that aren't aware. There we go. So they are this is their position naked. All right. So you can see on a one lot, if we tank, you're protected. And on the upside, you give up gains. So let me add in their actual position. At the time, we were trading 5610. So when I add in owning the S&P, this is what my stock looks like. So let's just say this was $10 at the time. And then let's say 100. And I'm going to say this was 100 as well. So they do this for 0 cost at onset. And this is what their position looks like when you're actually done with it. If the market goes up, you win up to a certain point. If the market drops, you are protected down to a certain point. And they do this every quarter, and everybody knows about it. And it moves skew. So now, I'm not going to accuse market makers of being shady or cheats. But if you had a customer that came in every 3 months with the exact same order for whatever product you do, all right, for whatever product, if you knew someone was going to come in with the exact same order every 3 months, what would you do? Cool Hand Vic says she would front run. You'd be a good market maker. And we don't like to say front run, but let's just say I would dutifully plan ahead. Well, you can't price gouge, and they will fill their orders. But ahead of this, if they can, they will build their positions in anticipation of this order coming in. So what does that mean for you? That means you're probably going to see a little uptick in downside volatility as we approach the 30th, the cost of options on the downside. And you may see the cost of upside calls coming in. Of course they do. Alicia says Morgan participates on their own customers' trades as well. Yes, they do. Which, if you ask me, is kind of a conflict of interest. So that is your story with this trade. Traders are getting prepped for it now. So that is going to move markets. Next. And hopefully you guys are enjoying my AI. So this is what a collar is, and that's what the JP Morgan strategy is. You know, they buy out of the money put, sell out of the money put against it, sell out of the money call. Limits both gains and losses. And so the ticker that you're following is JHEQX. All right. And here, this is the JP Morgan Hedged Equity ETF. Now, congratulations. One second, guys. One second, guys. You know, we told that kid repeatedly, hang up his towel, hang up his towel, hang up his towel, right? So, why? Because we live in Texas, and on the you know, we live in Austin near the desert, and my son wrapped, and you know what loves getting into a nice warm towel? A scorpion. So my son just got stung by a scorpion on his posterior. So thankfully it wasn't, you know, it was on that side of him, not the other, I suppose. But yeah. No, you can't make that up. But we warned him, hang up your towel. Oh, yeah, I sprayed it. I'm not laughing. I'm yeah, we're all kind of giggling about it. We knew it was bound to happen. Yeah. So, yeah. So I went up and killed it. Don't worry, folks. No, it wasn't. One of my clients said you're supposed to pee on it and suck out the venom. All right. All right. Now that drama has passed us, I apologize, everybody. Let's get back to business. The JP Morgan, this hedge, they're ready for it, and they're paying, and they're ready, and they're approaching it. Now, what makes this June one especially important? How did a scorpion get inside the house? I mean, we see scorpions probably once a week here. I mean, I have pretty good pest control, and it's just, you know, they've been digging up the ground, they're building, they just get in. Yeah. So the JHEQX, that's on the 30th. And then that's on June 30th. That is a special. This one is special. Why? All right. Why? Because of decay. Because of decay. All right. So it is June 20th. 2 weeks from today is what? July 4th. Now, I'm going to be doing work from Michigan in July 4th because I'm going to be relaxing and vacationing. All right. Now, what is going to happen during that week? Right. People take off. Right? Like we're closed on the 4th, obviously, because it's a holiday. But traders are off to the Hamptons probably as soon as, you know, they're probably leaving on Tuesday the 1st. Probably going to see that roll through and then leave. Or they're not coming back till the 8th or 9th or 10th. So if I knew that nothing was going to happen and we had a long weekend, What do you think I would do? And this is the same exact answer as if I knew that we were going to have quarterly, that I knew that we were going to have this JP Morgan roll. What would I be doing? Tom the Vixt says, I'd be selling options. Right. I'd be selling options. Why would I want to own something while I'm gone? I'd rather be short and let it pay for my vacation, right? Nothing's going to happen. We're on vacation. So, what are we going to see? We're going to see something very similar to what happened in December. You know, it took us a bit. We got this nice sell off, and then they took volatility down. And we made some real good money. And, you know, 2 years ago, you see the same thing. This is an annual event. The culling of the volatility is an annual event where you see volatility get absolutely slaughtered into Christmas. It gets so oversold that the options actually become almost free. And that is going to be a trade setup that is developing right now around, with quadruple witching gone and the 4th of July coming up, especially if there is a truce. The absolute thwacking that implied volatility is about to get is going to shock you guys. It is going to shock you guys. So what ends up happening is things get overdone. The market makers come in and start selling, and then some of the upstairs guys start selling. Next thing you know, these options actually get oversold. All right. So what I'm looking for, one, I'd love a peace agreement. And then two, we get that peace agreement, you're going to see the VIX get absolutely slammed. I'm talking maybe 14. And when we start seeing that rollover, we can do a lot of things. I'll tell you what I did last year, or at Christmas. All right. We've got this 4th of July holiday impact. Option decay continues to happen. And I want to remind you guys, and this is the setup we're seeing. And this is why I kind of want to have Andrew on to talk fingerprints here in a second, is, you know, last Christmas we did 7 trades. 6 of the 7 were nicely profitable. And this trade setup is re-emerging as we head into the 4th of July. And now, as we head into the 4th of July, we're going to be using fingerprints and knowing that this pattern is going to emerge. And we're going to be long, and we're going to take an opportunity to go long some equity names that we really like. It'll be Christmas in July. That's right. And Jose mentioned SFIX. SFIX is probably going to get a really strong rally out of this. And you're going to see UVIX, UVXY, all those names kind of get pummeled. So speaking of option fingerprints and Flash 5, let's bring in our own Andrew Giovinazzi. This is the one slide I had to do some editing on. I put some.
Wow.
I put some.
You have a slide and everything.
I know. You're changing the face of long-term investment. You've been a 30-year professional trader. You're the master of all things volatility. And again, you wrote the program that taught me how to trade. And of course, your fingerprints are all over the changing investment industry. But I was just thinking about this, Andrew, as I was kind of preparing for today. I was like, boy, Andrew's launching launching a new Flash 5 right into the 4th of July when things get absolutely creamed. Senor Roberto, there will be no rip zone today. This is rip zone essentially. The only fulfillment we're doing today is this, and then a couple of Flash 5 this afternoon and my masterclass. So Andrew, what are your was your timing intentional to kind of get at these, to start this product, to start doing this right as they're about to come in and have that JP Morgan roll and slam vol into the 4th of July?
Oh wow, SPY's starting to drop actually a little bit here.
Yeah, it is.
No,
you know what's rallying? But, you want to know why SPY is dropping? Oil's going up.
Oh, you still got the Middle East. You still got the Middle East.
Yeah.
Happening.
We do.
I think that's part of it. Also, it's rare that you get to the half of the year. And the market basically is unchanged, right? Where did we start the year this year?
Let's see, we opened. Yeah, the 31st we closed 58.81.63. We're currently 59. We're up 80 points year over year, or since the beginning of the year.
Up
80 whole lot of nothing. I mean, you would think a whole lot of nothing, but we've had some action in between there.
1%?
Yeah.
So
like 1.5.
So a couple of things is when I look for these stocks, when I look for these stocks, I'm looking for thematic events. So just as a reminder for people, when I'm looking at Flash, before it was Flash 5 or Flash 10, it was a technique because institutional customers bought options, right?
Yeah.
And what I learned early on was like, they hold them all year. Oh my gosh. Not only hold them for a year, but sometimes 2 years.
Yeah.
And then they'll roll up. So that's something that you see in, let's say Delta Strike all the time, right?
Mm-hmm.
You're like, who do you like following the most? The guy that just buys some calls, or the guy that bought his calls for $1, sold them at 10, and then bought more at $1?
The latter. Right? The latter.
You like that one?
The only way I like it more is when they lever. Is when they roll and lever. That's when those are ones I like even more. So they sell 10,000 to buy 20.
Right. But this year the market basically went nowhere. But as I look at the second part of the year, where are the opportunities still coming? So I wanted to go over a stock. I had this stock for my Flash 5 people, but it kind of already blew up on the upside. but I'm still going to give the name and go through the fingerprint on it here
Okay.
today. Um, and but the stock kind of ran already.
Well, but it's good to show, I think, how fingerprints work and how you
right,
saw them
right,
coming
and that's
before
what
it
I'm
ran.
going to do here.
Yeah. All right.
So
So what I'm going to do is I'm going to leave everybody in your safe and strong hands, Andrew.
right,
And I'm going to wish you a happy Friday, and I'm going to watch. I'm going to let you go, and I'm going to watch and enjoy your discussion.
right.
All right, everybody. Have a great morning.
So right now, this is Reddit, and Lisa will be on. Lisa will be on, I think, at 11:30. I wanted to go over this, and then I'll give you some of my market thoughts here right at the end. But the thing with looking at fingerprints or you want to see institutional accumulation. Now, this stock I was going to add as an extra one for the Flash 5 people. But when we talked to Hannah last week, we were trading about 109, 110, and the stock's already up $30. So it is very hard for me to do a call buy program when the stock already runs. And that was also part of my I prefer the stocks to wait to pick up some interest. But Reddit has already run. So what I'm doing in Reddit right now is I'm just selling puts at the 120 level. Just one or two, which is plenty. Generally, I sell the 100-120 put spread when it kind of moves up like this. But I'll go over a call spread I think is pretty cool, but it's not cheap either. But all these options are a lot more expensive than they were just a week ago. But I want to go over the fingerprints first. So one thing is in Reddit here, I want you to take a look at this. So a couple of things is so from my point of view, Reddit is an interesting stock because of the network. You could see that Facebook is starting to use AI to improve the value of their network, and Reddit will be doing the exact same thing if it hasn't already started to do the exact same thing. That is one of my themes with stock picking. I like to have a market theme that the market is playing out. So, for this year, the stocks I'm interested in are going to be the ones to benefit from AI, not necessarily the ones that have already garnered the huge market cap already. The thing that's helping me do that ultimately is how much open interest I'm seeing in the long-term options. So I want to give you like a sample here on Reddit. So how does that sort of break down? So what I do is I like looking for relative lows in the stock. So what you want is Reddit this year was as high as 228. It traded down to here. I think a 6 to 9 month price target is $200 again, just because it's that kind of stock. It can fly for no particular reason. So, but the options are a little pricier now out in January, but I do have an idea for it. But anyway, so what I want to see is I want to pick days, right? Here, let's just take a 1 year look, right? So the stock traded as high as 233 and kind of the go-go days in February before all the Trump stuff. It's starting to make its way back, Now, I do want to show you a picture of what the price of long-term volatility looks like. So right to around half of the year. Okay. It's definitely not as low as it was. So when Reddit it was kind of hanging around here, not doing very much. The option price is around the 55% range. Right now, those options are going to be about the middle of the range, which would cause me to buy a spread, which is what I'm going to do. Also here at the top of the range, this is as high as the volatility got. So when you're looking at trying to do this for yourself, looking at open interest for yourself, and LiveVol is a great tool for this, for kind of looking backwards. Thinkorswim has, I think, Think Back, where you can go back in days. But LiveVol makes this type of analysis really simple. So what I want to see is how much where am I here? Oh, I think I have it up already over here. Nope. So I'm looking around early April. So what I want is, I want a time when everybody is just getting out. So you want to find a place where for your particular stock you're looking for, if you're interested, is when are folks getting out? And generally for me, I think that coincides with relative highs in volatility and relative lows in the stock price going back over generally the last year. So you want to pick a starting point where people that want to bail, investors that want to bail, this is when they're bailing. How does the stock go from 220 back down to 73 bucks, right? People get out. Investors get out. Institutions get out. They get the heck out. But what I want to see is how many institutional customers are staying in. What's the open interest look like of people staying in? And that's what we're going to do. So we're going to look at August.
Mr. Andrew.
Yeah.
I think you're supposed to share your screen.
Oh, thanks for letting me know.
No problema.
So I've been talking this whole I forgot Mark was sharing.
All good.
I'm glad somebody's paying attention. Sorry, guys. So all of that, I wasn't looking at the chat for a second. So anyway, here's Reddit. Here is 180-day volatility, which is basically means this is option pricing all the way out to January of 2026. Stock high around 226. Stock low recently, probably in the 80s. And again, this is a name, like I said, I believe network value of these companies will continue to increase. The value of their data, all the information that they have on their website, in their infrastructure will continue to pick up value. So what I want to show you here is volatility at one point got really low, right? When everybody's like, oh, Reddit, big deal. And then all of a sudden they started making money, right? And from what I can see, they're starting to monetize quickly. To me, again, it's a personal holding. It's actually a fairly good size holding at this point. I even put in my wife's IRA. But I think this is a stock that has a lot of long-term growth potential. Because it's basically, this is, I guess, when you're a kid, we used to have newspapers. Well, all the younger set, what are the Gen Z or whatever they are, millennials, right? This Reddit's their way that they get their news and information. So, but what I would say though, is this long-term volatility is about in the middle of the range. So it's a relatively new stock for options, but 75 volatility for $140 stock is pretty high. So anything I would do in here, really, I'm looking to spread that. So what I was saying for option fingerprints is you want to see when institutions, everybody's just getting out. And for me, I like, right, the easiest way to tell is relative market lows for your stock and relative highs for volatility. That is traditionally a pattern of basically capitulation. People are like, I got to get out. I got to get out. So what I want to see is how much customer, right, institutional and retail customer interest, but mostly the institutions play in the long-term options. And when I look at it here, here we go. All right. So here I'm going to go out to April. Let's go right to I think this is pretty much the bottom, right? This is when everybody was freaking out. The next week was pretty bad, but everybody was kind of freaking out a little bit. So, and this was only a couple of weeks ago, right? I'm sorry, a couple of months ago. So this is April 4th, 2.5 months. So what I look at is I generally like to look at it's usually 6 to 9 months. The January options, the ones institutions generally go for now they're looking at 2026. The 2026 OI is probably where it's going to be. It might, can grow obviously a little bit, and especially as it becomes a normal option. It's in April. It's still, I would say, just out of the cycle of options. But what you want to see is, okay, what are they doing? Okay, how much open interest? And I have to say it was surprisingly light in April, meaning there wasn't a lot of institutional for a stock that was as popular as it is. There wasn't a lot. So the open interest, I want you to focus here on this left side. And let's look at some of so right now here, like the hundreds, there was 467 contracts, the 110s, 394, the 120s, 333. This is all your in the money open interest was around. Here is again, the 60s is probably the biggest amount, about 594 contracts. The 70s, 245. The 75s, 107. So what I want to see is this number, first off, is the in the money open interest staying open? Meaning whoever owns these options, they're not getting rid of them, right? Is it growing? And then next, is that out of the money open interest starting to grow? Because there was, and there was open interest up here because remember the stock at one point during this cycle was $220. So there are some options up here. So what's funny is you notice there's more open interest out of the money now from the 170 to the 220s, probably as a result when the stock was 240. So this is, I think, some people probably getting into the game a little late. And these obviously were folks getting into the game a little earlier. Now let's kind of fast forward to what's going on today. Let's see if there's been a little pickup in options, basically like right around the money. And I'll answer some questions here in a couple of minutes. All right, so let's see here what we've got. So 115s and 120s, those numbers have jumped into the thousands. Let's take a little look for comparison. So that was 901, 333. So when I started to calculate this, I had the open interest had jumped about 50%. I like at least 25% jump in the OI over a short period of time. So this is like 2 months. Now, what would I expect? Now, all of a sudden, right, you have the old 110 open interest here, right? There's about 1,200 contracts. And now, all of a sudden, all of these options are $15 to $20 in the money, right? All this open interest has basically doubled or more all the way down the line here, and they're not selling, okay? They're not selling. So what I would say is now up here, there's been a little bit of a jump in some of these upside calls here. I think the 200s are now the open interest on the 200s are 400. So again, is there money reaching for these calls? It was 2,700. It's roughly doubled. So when I look at the open interest, all what we have in a 2-month period of time, and the stock really hasn't done anything a whole lot until the last couple of weeks. It's certainly not 89, but it was trading like around 100, 115, kind of vacillating around there. But now all of a sudden you have tremendous change basically in posture. So the idea is, as open interest increases, that is a tell, right? A fingerprint for more institutional interest coming into the stock. And you want to see that. A lot of stocks just don't have any real change in open interest. The more, the better. So right now, I've got a bunch, at least I would say 50%. It's probably a little more. I did just a relatively fast calculation, but this is only in 2 months. So part of what Mark was saying about, July 3rd, where there's basically going to be another volatility anomaly, where traders take the implied volatility down for the holiday. And I believe the 3rd is on a Friday this year. I'm trying to see here. Yeah, 1, 2. I think the holiday is going to be on a Friday, I believe, for the 4th. But what happens is traders will take volatility down into that area. So you have basically a dead zone where you could buy options without a lot of decay penalty. So the trade I like for this right now, so I have one, what's happened in the stock? What do the things that I like the most? One, industry that I have an interest in, but anybody could have an interest in it. 2, the stock has bottomed and is at least 10% off the bottom. And then 3, is there real upside call buying? Are people interested? The more you see, and Mark does this in Delta Strike a lot, and I've been seeing some option buying in Intel as well lately, just as a side. But generally, right, you want people buying options, institutions buying options. You're looking at all the known information when you look at it. So they're out screwing around looking for, what they think is the best thing. But the fact that they're coming into the options of buying ultimately is the information that you want. And the more interest, I think, the better. And that's how stocks kind of become, they get in that sort of hyper growth phase. And that's what I'm looking at. So the first 6 months of the year, basically, the market has gone nowhere. Actually, earnings haven't been too bad, but overall, the market's basically not gone anywhere. So I think you don't normally get opportunities where you're halfway through the year and the market hasn't gone anywhere. There has been a lot of, I would call, chaotic announcements and stuff. But I think that's an opportunity. So for Reddit, the trade I liked, I think the stock's going back to 200. I thought an interesting, a nice call. The price of the call spread is going to be around $1,000, but I thought the 180, because all this upside vol here, I want to show you again. And here's another thing. You have pretty high volatility all the way up and out, meaning the volatility at the money right now for the 140s is 72%. For a stock like Reddit, there's no downside volatility skew. And what I mean by that is there is actual vol buying of out of the money calls that lift the implied volatility of these strikes. So there's a lot of interest in buying this upside stuff. So what I like to do for a trade, especially when the vol I think is relatively high, is I want to buy something closer to the money and then sell something more out of the money. So my idea here, this would be in lieu of shares. So normally, if you buy 100 shares of Reddit, it'd be $14,000 for 100 shares. You can buy a one lot though for $1,200. Now, it's not nothing, granted, but the 80/50 is around $12. Now, can we get to 250? Yeah, I think it's easy. I think the stock could easily go to 200 and possibly more. So how I kind of think of where a stock could go is I take the value of the straddle, and then I double it. So that's a range. And you would see when stocks basically start deciding to go one direction, it's giving you kind of an idea what you think the stock could do. So Reddit easily can be, so the range would be, 120 bucks. The straddle's 60, twice the straddle's 120 bucks. So the stock can, right? Because remember, the market is pricing January volatility relatively high, meaning, hey, this stock can go. They're pricing, and a stock can go down as well, but they're also pricing, right? Because the traders, the market makers want to price this long-term stuff to try to capture the range of the move. And that's why it's priced like it's priced. So when I look at this, I want to make sure that the strikes that I choose are going to be sort of within the range. I don't want to pick something that's too out of the money. I want to pick something that's in the money. And from my point of view, the 180 calls, right, are trading around a 77. The midpoint of the volatility is around 70.75. And I get to sell volatility, right, or options that are $70 away for roughly the same volatility. So from a trading point of view, you have a spread that has almost no decay in it. So here, we'll take a look for a second. Let's see if I got Thinkorswim will cooperate with me today. See what we got. All right, so let's take a look. And I'll just give you like a simple difference looking at a spread. So if we go to Reddit, and so I go out and just buy the straight January 180 call, and I spend $1,900 on it. Again, I view this in lieu of stock. If you're going to buy 100 shares, you buy the call instead. So this option is going to decay at $7 per day. And by the time, again, right around here, if we're waiting again till the end of the year, you're probably going to be up around $5,000. Okay, that would be pretty thrilling, right? Now, but if I trade the spread to 250, and again, when I trade a spread, I'm selling options where I think that's sort of the terminal place for the underlying, right? Now my decay per day drops to 183. It's pretty low, and we have 210 days to go. So we're going to decay around, again, about $1.80 a day. So, but my option decay has actually dropped like 80%, which is what selling options out of the money for good prices gets you. It gets you a trade that costs much, much less per day. The second part will be how does my trade perform at 250, right? I'm buying the 180s. I sold the 250s. I'm in it here for about $12, according to this. And at 250 here, again, I'm going to be up $5,800. So you actually can get better performance at your target if you trade a spread, because the spread costs you about half as much as the original option. That's why you trade a spread. Are you going to get better performance or not? The only time you want a spread is you get better performance, and you save yourself some money, so that money increases over time. So one thing that also goes into me picking the particular stocks is what really is the profit potential of the options versus where they're priced currently. And, you know, I wanted to give this away today, mostly because this was on my list. We started last week. Reddit was about $115 and the stock's up $30 already, which of course isn't helping anybody. But, you know, the stock up 30 makes it a little less appetizing. But for me, I'm just going to sell a couple of 120 puts in here and take delivery and actually wheel this stock and have some fun. I've had a lot of fun trading the stock, using $100 basically as an entry point. And I think now it's probably on the way to that. The ability to sell puts and take delivery lower is going to be tougher. And I'm kind of going to switch to just buying calls or call spreads. So I'm going to buy a couple of these call spreads anyway. It's a lot cheaper than buying more shares. And the fact that we've had such a solid increase in option fingerprint over the last couple of months, when the market has been going up, but this Reddit really hasn't been doing a whole lot until just recently. And I think this is, again, it's an opportunity, right? Mostly because of the action and some of the buying that I'm seeing in long-term options. So you could see here over the last, let's say 3 months, it's been pretty flat, right? Since the 4th, hasn't done a whole, you know, we had that one really bad day, right? When everybody was selling everything, but for the most part, it was kind of just hanging around 100. So again, a spread is a nice thing to buy. Why? Stock pulls back. You can close the short option contract and then ride the rest of the options higher. If anybody has any questions though about this particular thing, I can answer some. What is the expiration on the puts? I'm selling the July's, Harple. Does it matter if everyone is selling calls or buying calls, or does it matter? The 4th, everybody's telling me the 4th is Friday. Oh, yeah, it is. Sorry, guys. Thanks. Well, Carol, this is the reality. So from my floor trading days, most long-term options are bought, not sold. I could count maybe on one hand the amount of time institutional sold January options, because it doesn't really do anything for them. Remember, most institutions like pension funds, it will think about it this way. If you're a pension fund, you have monthly cash needs. So if you're selling options that expire in a year, is that really helping you? To be honest, Rawhide saying, if you think it's going to go to 200, why sell the 250s? I think it can go higher, to be honest, Rawhide. But if I'm adding this trade to, let's say Flash 5, I would trade the 8200 for smaller dollars. Right? To bring the cost of the trade down. If you're looking for something to replace the stock, I would pick the wider spread. Does that make sense? So if this was a trade that was going into Flash 5, when I talk to my Flash 5 people at 12, I'll say, hey, here it is. Stock's up 40 though. Okay, kind of sucks. But this is a relatively inexpensive trade. If you're looking to replace the stock, yeah. There we go. If you're looking for something that's a stock replacement, that's basically costing you a fraction of, right? Could you please add the trade in the announcements? I don't think we do that here, Bruce, for this. I guess I could. Hold on. Do you know offhand, okay, a bunch of other questions here. I could put the trade in the announcements and then everybody can do what they want. Can you guys see it on the screen though, where it is right now? Okay. I'm gonna post it here though for you, okay? Okay, so and also everybody at Option Pit, just to let you know, we record everything and post everything. Just so you know. Let's see here. So this is buy to open one right. So I'm going to post it in the announcements. There you go. What's your exit strategy for this trade? So to be honest, with this type of trade, Pelling J, this is just an allocation trade, meaning I'm going to spend about 2% of the account on the value of it. The only thing I would do is close the short call on a pullback. As far as managing the trade goes, I would basically sell a put against it at some point, but that's what I would do for this particular one. And if I'm being realistic, if you have this trade on and you want to have a good way to manage it, if it's down 25%, just close it and look to enter it again. Just depends on what your personal, what your personal risk tolerance is for any trade. I'd probably buy like the 100 put, Jose. Because that's basically, if the stock goes below 100, something's wrong. So, but the value of a put like that can get real expensive that far out. So, but again, this is an idea of there is accumulation. This is an area that I am interested in. And there's enough accumulation that I thought it was worth adding. We'll talk about it for the Flash 5 people today. If you want to join Flash 5, there's still time. One of the trades I put out is up, I don't know, like 75 cents already a contract. But it's still an attainable option easily. So at what level would you buy back the short call? Probably half, Robin. I'm in here. I'm selling 120 puts. Carol, when did you put out a trade and where is it? So are you talking about Flash 5, Carol? Or for this particular idea, just hanging out here because you came here? For Flash 5, Carol, you go to the portfolio page. And that's where everything is. I put out an announcement on Monday, I believe, to alert everybody, or Tuesday to alert everybody. So check out the portfolio page. Upside to sell on this. I mean, for particularly like this type of trade, if I'm in for $1,200, I would take $3,000. But again, you're buying a January contract because you expect the stock to go up over time, right? Stocks can do this. right? The option fingerprint idea is not just like stocks going up right away. Sometimes they do, okay? Sometimes they're not going to. The idea is being able to hold onto it for 6 months and participate in a larger gain. Now, I think Alicia's on. Is Alicia on at 11:30? Let me see here. Yes. So, yes, this session is in lieu of the Friday Rip Zone session. That is correct. I am going to put out some Rip Zone notes, though, for people at the end of the day, see kind of how things close here. Let me find out what's going on. So I thought Alicia was going to be on 11:30, but maybe is there any point in selling a call in a less far out series? So, Carol, you have to kind of explain what you want. So, what call are you buying and what call are you selling? Okay. So, you want to buy the 180 and then sell a short dated one? Right, like October or something. You can do that. It's just trying to sell a call with enough premium to make it worth it. You know, the problem with a stock like this is it can. So everybody has to be clear with a trade like this. Number one, you're spending pretty substantial money on it. Two, there's a gain in institutional open interest, but the idea is to hold the position. It's not just like an option trade where you're like getting in and getting out of it in 3 days. Would you consider doing a leap and riding out of the money diagonals to reduce the cost? I mean, you can do that, WA. I just for trades like this, I just view this as I'm going to buy this instead of the stock. And I'm going to take the money I would have spent on the stock and go do something else with it. If that's clear for everybody. I guess Alicia's not on today. Oh. me see here what else we got. Yep, I'll be sending. Well, we also I already posted notes for Rip Zone today. Will you do it differently if you already own the stock? Will I own some shares, Pelling J? I'm just looking to add a few more. That's all. So, you know, everybody has to, you got to decide on what's going to work for you. But I'm just getting longer, and this is how I'm doing it. So the Rip Zone notes, guys, for everybody in Rip Zone, should have gone out already. Carol, there is no current Reddit trade. There is no current Reddit trade. Yep, and this is being recorded for replay. We're going to talk about it today in class. Yeah, guys, everything is recorded. There is no, okay, so there's no normal fulfillment today, you guys. This is it. I'll send everybody updates for our classes. There's trade to close at noon, and so there's trade to close people at noon. I'm doing Flash 5 at noon, and Mark is doing the master class at 1. How come there are no notes in Rip Zone? Let me see. I posted them around 10, and they should be out soon. They should be out shortly. Where? So they go in the announcements, Vicky. They get sent out via email 3 times a week. All right, everybody. Well, if you are getting longer, should we get into hymns? Oh, that was one of my Flash 10s from last year that I just missed. So, by the way, that's the same thing. So I'll just give you an example. Last year, when I wanted to add a stock to Flash 10, it was hymns, but it jumped like 40% right before, I started the program. And Reddit's doing kind of a similar thing, to be honest. But that's kind of funny, Eric P. It took me a second to figure that one out. All right, I'm just going to, since everybody's having problems with it, I'm just going to put them out in the announcements, Will, as soon as I'm done here. Okay. All right. Do we go up here? I think we're going to end the day just basically unchanged. So, Cap, the June 2nd weekly profit cycle recording, there was a problem with the recording, so that's all it is for that one. I don't know what happened to it, but for some reason, the system did not record it properly. Sometimes that happens. All right, everybody. Well, have a good weekend. Kind of a shortened week. AG sent out an email just before 10 a.m. for Rip Zone. There you go, Robin. But I'll post it. I'll post it to the notifications here in 2 seconds. So are there any questions about, again, if you want to join Flash 5, you can. It starts today at noon. The 2 trades are still in range that I put out already. There will be 4 more and hopefully more for this year. So we'll see how things go. All right, everybody, have a good afternoon and take care. Yeah, the only place where 2 + 4 is 5. Bye-bye.